Have you ever wondered what the financial world would look like without banks, brokers, or any central gatekeepers? What if finance was run by code, open to everyone, and completely transparent? That's the core promise of DeFi, or decentralized finance. You've probably heard the term buzzing around, with some calling it a revolution in money. But what is it really? In this video, we're going to break down DeFi, explore how it works, what its key components are, and look at both the incredible opportunities and the real risks involved. To understand DeFi, we first need to look at the system we use every day, traditional finance, which is highly centralized. When you get paid, your money lands in a bank account. Every payment, loan, or investment you make goes through regulated institutions. This system gives us stability and legal protection, which is great, but it also means we depend on these central players. A bank can freeze your account or block a transfer. A central bank can print more money, potentially reducing the value of your savings over time. And while this system works for many, billions of people around the world are still unbanked or face challenges like hyperinflation. DeFi offers a different path of financial system that's open, borderless, and not controlled by any single entity. So, what's the magic behind DeFi? It's built on three technological pillars. First, cryptography, which keeps your identity, transactions, and data secure. Second, the blockchain, which is a shared, unchangeable public ledger where every transaction is recorded for all to see. And third, smart contracts. These are the real game changers. A smart contract is basically a program stored on a blockchain that automatically executes when certain conditions are met. Think of it as a digital vending machine. If you put in the right amount of money, it automatically gives you the snack. A smart contract might say, if person A sends 1 Ether, then person B automatically receives 1,000 digital dollars. No need for a clerk or a notary, just pure, verifiable code. Most of this activity happens on blockchains like Ethereum, but other networks like Solana and Avalanche are also becoming major DeFi hubs. Now, let's dive into the 5 core pillars that make up the DeFi ecosystem. First up, we have stablecoins. These are cryptocurrencies designed to hold a stable value, usually pegged to a real-world currency like the US dollar. They act as a bridge between the old financial world and the new crypto one. Some, like USDC, are backed by actual dollars held in a bank. Others, like DAI, are backed by other crypto assets locked in a smart contract. Stablecoins are crucial because they let you trade, save, and make payments within the crypto world without being exposed to wild price swings. The second pillar is borrowing and lending. Just like in traditional finance, you can earn interest on your assets or take out loans. But in DeFi platforms like AB and Compound let you do this without a bank. Lenders can deposit their crypto into a pool and earn interest, while borrowers can post collateral to get a loan. The interest rates are set by supply and demand, and you can see them change in real time. Why borrow if you already have the assets? Well, you might want cash to invest in a new opportunity without selling your long-term holdings. A cool innovation here is the flash loan, an uncollateralized loan that is borrowed and repaid, all within a single transaction. It's a powerful tool for advanced trading strategies that simply can't exist in traditional finance. Next, we have Decentralized Exchanges, or DEXs. If you've used a platform like Coinbase or Binance, you've used a centralized exchange. They hold your funds and match buyers with sellers. DEXs like Uniswap or SushiSwap are different. You trade directly from your own wallet via a smart contract. Instead of order books, they use liquidity pools funded by other users. Traders pay a small fee, which goes to the people who provided the liquidity. The big benefits here are that you always control your funds, there are fewer barriers to entry, and you can access a huge variety of new and emerging tokens. The fourth pillar is insurance. DeFi is creating new ways to protect against risk. Imagine a farmer taking out a policy that automatically pays out if a trusted weather data feed confirms a drought. This is called parametric insurance, and it's perfect for smart contracts. Within crypto itself, protocols like Nexus Mutual offer cover for risks like smart contract bugs or exchange hacks. It's an emerging field, but it's a crucial part of building a more robust financial system. Finally, the fifth pillar is margin trading. This involves borrowing funds to amplify your trading positions. In DeFi, this is all handled by smart contracts that manage your collateral and automatically liquidate your position if it becomes too risky. Leverage magnifies both gains and losses, so it's a tool for experienced traders and should always be approached with extreme caution. Beyond these core pillars, DeFi is constantly evolving. You'll hear terms like yield farming, which is the practice of moving your capital between different protocols to maximize your returns. There's also staking, where you lock up your assets to help secure a network in exchange for rewards. And one of the most exciting new frontiers is the tokenization of real-world assets, or RWT. This means creating digital tokens that represent things like real estate, government bonds, or even company invoices, bringing them onto the blockchain for 24/7 trading and fractional ownership. So, what are the big takeaways? DeFi offers some incredible benefits. It's open to anyone with an internet connection. It's incredibly transparent, and by cutting out middlemen, it can be more efficient and cheaper. The money Legos nature of DeFi also means developers can rapidly build new and innovative financial products. However, the risks are just as real. Smart contracts can have bugs that lead to losses. Market volatility is a constant threat, and the regulatory landscape is still being figured out. There's also a steeper learning curve. You are your own bank, which means you're responsible for managing your own security. How does it really stack up against traditional finance? In DeFi, you control your assets. In TradFi, an institution does. DeFi is permissionless. TradFi requires approvals. DeFi settles in seconds. TradFi can take days. But TradFi offers legal recourse and deposit insurance, while DeFi relies on code and community governance. It's not about one being better than the other. They're different models with different trade-offs. The future will likely be a hybrid, with traditional finance adopting blockchain technology and DeFi becoming more mature and secure. If you're curious and want to get started, my advice is to educate yourself first. Learn how crypto wallets, seed phrases, and gas fees work. Always stick to well-known audited protocols and be wary of anything that promises impossibly high returns. Start with a small amount of money that you're comfortable losing and never put all your eggs in one basket. DeFi is still in its very early days, but it has already fundamentally changed the conversation around money, ownership, and access. It's the promise of a programmable, global, and transparent financial system. And it's definitely something worth understanding. Thanks for watching. If you found this explanation helpful, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our next video. Stay curious, stay safe, and see you in the next one.